Hello, I'm Valerie Miller, and welcome to this presentation of the online business strategy game for Company C. A brief overview of the business strategy game includes 6 groups competing against each other in a simulation of managing an athletic footwear company. Our company was letter C, which we named Chaser. We are going to follow the decisions of the company in specific areas that may have contributed in the company's success, as well as challenges that were analyzed thoughtfully to make the best amends as we moved forward. The marketplace worldwide focused on all productions and sales that were pursued in 4 regional markets of North America, Europe, Africa, Asia Pacific, and Latin America. From there were 3 market segments that included internet, wholesale, and private label. Every group started out in the same position with equal sales volume, market share, revenues, profits, costs, etc. Each decision round was equivalent to 1 year. Everyone was provided with 10 years of history, and at year 11, each company assumed management. We will now take a closer look at Chaser Company successes and challenges. Our group, Chaser, finished with the business strategy simulation game in 5th place at the conclusion of year 16 with an investor expectation score of 52, best in industry score of 41, weighted average score of 47, and a -4 change from year 15. Our final results came down to a 54 investor expectation score, a 45 best in industry score, a 50 weighted average score, and finally an overall game to date score of 52. Our group worked collectively on decisions for each section from years 11 to 16. After each year, we were able to look at our results in comparison to other companies or competitors. Having the opportunity to review all the details was indeed a factor that contributed to our decision-making process for the following year. To sum up our strategy in making the best possible decisions, we thought at the time, I'll review some moments where we faced challenges. Our first few slides we're going to look at include the internet marketing segment. Before our group jumped into the simulation, we met and decided to split up each section tab among the 4 of us to evenly distribute the workload and make it fair for everyone. One of the tabs I handled was the internet marketing. I now know, looking back, that setting the retail price so high in year 11 maybe wasn't the best decision. I should have increased the retail price gradually over time. My strategy for the internet marketing was to analyze what didn't work and even compare to those teams or other companies who were having more success, like Group A, which was a component of our opportunities and threats of the SWOT analysis. I tried to determine their strategy that clearly was working for them as they came out on top as number 1 at the end of the simulation. I also paid close attention to the market share percentage, doing my best to figure out a way to get the percentage at an appropriate level or high enough to demonstrate competitiveness. A higher market share allows for a company to increase profitability and growth. I know I keep mentioning Group A, but their success has taught me so much over the course of these 6 weeks. I was able to look at what may have gone wrong for Chaser and what worked well for Group A and compare results and decisions. Again, I noticed Group A's results had a market share that was higher than all the other companies, including ours, which checks out. The market share for our group Chaser never reaches at or beyond the 20% threshold, and in fact decreases between years 12 and 13 for the North American segment. In fact, looking at Chaser's market share across all geographic regions, the market share never reaches 20% or more and fluctuates between 10% and 16% roughly. Additionally, the challenge that complicated our internet marketing segment that I should have taken into consideration is how the price changes influence consumers. The frequency of price shifts leaves consumers with the impression that the price would continue to move in that same direction. I set the bar high with a starting retail price of $80 across all regions for the internet marketing segment, and then by year 12 in North America, I dropped the price by $8 to $72. I dropped the price again to $70 by year 13 and then increased it again to $73 in year 14. The price remained $73 in year 15 and I raised it once more to $73.50 in the final year 16. I noticed our online orders fluctuated as a result of the retail price changes too. It was tempting to lower the price over time, which I did for 2 years, which likely resulted in consumers assuming that the price will continue to fall, making them hesitant to buy shoes. A single price drop makes it more likely for consumers to expect a reversal or a single large increase in the future. In the same breath, should I just have increased the price maybe one time, consumers might expect it to fall again, but repeatedly increasing the price in small increments without the notion of pricing out buyers entirely, consumers may actually expect the price to continue to rise, so they buy before it does. The next segment we're going to look at is the wholesale marketing segment. We learned through the player's guide at the beginning of the simulation that charging a wholesale price above a region's all-company average puts a company at a price-based disadvantage in competing against rival companies, whereas charging a below-average wholesale price results in a price-based advantage over rivals. The more a company's wholesale price to footwear retailers in geographic regions is above the all-company regional average, the bigger and more important its pricing disadvantage, and the more that footwear consumers in that region will be inclined to shift their purchases to lower prices for footwear consumers. The inverse applies when the wholesale price to retailers is below the all-company regional average, hence a greater pricing advantage and the likelihood of attracting the region's footwear shoppers to purchase its lower-priced brand. It became more clear to me that lowering the internet price can cause the cannibalization of the wholesale segment, since the gap between internet price and wholesale price is related to the number of retail outlets that will carry our footwear. One of the best ways to increase market shares on internet and wholesale marketing can be done by increasing advertising spending, but another approach involves research. Our group did a great job researching the market and looking at reports. Looking at this snapshot of year 16 with Chaser's North America wholesale segment, we see that the wholesale price was set at $51.50, which compared to competitors is the second highest price, with the industry average rounding out to about $51.33. Our price may be a little over the average, however, the other four groups like A and F had successful market share percentages because of their price points, and even the celebrity appeal positively affected them, which was also greater than our group, Chaser. We'll look at the private label segment last. With the private label segment, it was important to at least meet the minimum required SQ rating. Our company did so until the last 2 years, 15 and 16, with our rating equaling 0. This segment proved to be tricky and acted as a challenge because any given company can simply outbid or undercut another company. Throughout the simulation, the game profits in private label marketing becomes smaller. It is all about knowing when to pull out of the market. The picture here on the slide demonstrates Chaser's year 16 numbers and predicted numbers of 0 for year 17. I like to think that if our group adopted the Six Sigma mindset of focusing on the customer, measuring the value stream and pinpointing any problems, dispose of what's deemed unnecessary, keep the ball rolling, and ensuring a flexible environment, we might have been able to improve our score under the private label segment. We're going to take a look at our last few slides, which includes Chaser's stock price, earnings per share, and credit and image rating. Chaser stock numbers aren't the best in comparison to the other companies, which is a potential area that could have been improved upon. Judging by these numbers, it may have been beneficial to look into significant stock repurchase to help increase our stock prices. Again, looking at Chaser's earnings per share, had we maybe considered more stock repurchase, we could have seen better earnings per share over the years. Although earnings per share growth circles back to substantial growth in revenue and net profits as well. The best cost strategy benefits the company's image for the mere reason that increasing the SQ rating while having lower price is related to achieving a high image rating. Aiming for at least 20% market share in each segment bodes well for the company's overall image, and with it being evenly represented across the geographic regions, further eliminates any discrepancies. The image rating is also somewhat easy to influence and can be done by spending money on ethics training and eco-friendly packages, to name a few. Overall, Chaser's business strategy was well-intentioned and thought out thoroughly. Unfortunately, it came up short in the overall game. However, I imagine this goes for my group as well, that everyone in Group C, including me, learned a great deal about creating and executing strategies for competing in a global market. This concludes the presentation on the business strategy game for Group C, Chaser's Company. Thank you.